Welcome to the Explainer. Look, if you've even glanced at your portfolio lately, you know exactly what I'm talking about. We are literally swimming in an absolute sea of financial noise right now. From AI chatbots pitching the next big stock to breaking alerts on global trade wars, it is incredibly overwhelming. So as your guide, my goal today is really simple. We're going to cut through that static, filter out the hype, and distill the actual signal so you can protect and, more importantly, grow your wealth. Let's just dive right into this with a question. Would you let an AI manage your life savings? I mean, it sounds like some futuristic sci-fi movie premise, right? But it's explicitly entering the wealth management space right now. OpenAI is actively piloting a new finance-focused feature inside ChatGPT that lets users connect their bank and investment accounts directly for tailored financial plans. And meanwhile, brokerages like Robinhood are announcing entirely AI-driven trading agents. And get this. According to a recent McKinsey report, over a third of consumers, across all age groups by the way, are already using AI platforms to help with investment guidance. Literally millions of people are completely bypassing traditional human advisors and just asking chatbots how to budget, where to invest, and how to plan for major life goals. But before we completely hand over the keys to the algorithm, here is our roadmap for today. We'll be covering navigating financial market noise, tech trends in AI and betting, the social media trap, private assets and illiquidity, geopolitics, tariffs and trade, and finally, we'll wrap up with your smart investing playbook. All right, Section 1, Tech Trends, AI and Betting. So, the massive risk we really need to talk about here is AI hallucinations. Think of asking an AI for financial advice kind of like Googling your medical symptoms before actually seeing a real doctor. It's super accessible, sure, and it can be great for just general information. But you have to remember, these language models are prediction engines, not judgment models. They can confidently present totally fabricated information as absolute facts, and they completely lack a fiduciary duty to you. Trusting them with your life savings without any human verification is a huge risk. And speaking of risky tech trends, let's look at prediction markets for a second. Platforms like Polymarket and Kalshi. They claim to be these sophisticated tools for hedging risks and forecasting data, supposedly powered by the unbiased wisdom of the crowd. But the reality? They function a whole lot more like gamified casinos. The data shows that 84% of retail users actually realize negative returns, with a median ROI of -8%. Plus, their whole structure makes them super prone to insider trading and market manipulation. They're just not the reliable wealth-building tools that their marketing wants you to believe. Moving on to Section 2, the social media trap. If you spend any time online at all, you've definitely seen these wild TikTok promises, right? Stuff like turn a $2,000 tax return into $110,000 in just 6 months by buying AI stocks. And hey, it is incredibly tempting to chase those quick returns, but we absolutely have to counter those gamified fantasies with historical math. The market reality is that even the high-flying, massive growth tech sector within the S&P 500 has averaged a return of about 20% annually over the last 5 years. Now, 20% is fantastic, but it is nowhere near a 5,000% gain in 6 months. Do not let viral algorithms derail your actual financial reality. Okay, Section 3, Private Assets and Illiquidity. We're seeing this massive shift right now toward alternative private assets being heavily marketed to everyday retail investors. So what exactly is private credit anyway? Basically, these are non-bank financial intermediaries lending money directly to private businesses. You can think of it as private equity's lending cousin. This asset class exploded after the 2008 banking regulations forced traditional banks to kind of step back from riskier business lending. Private credit stepped right in to fill that gap, offering investors high yields through floating rates. But, and this is absolutely critical, it operates with just a fraction of the transparency and oversight that you'd find in traditional banking. And this space has just aggressively expanded. If you look from 2009 to 2023, the private credit market grew tenfold. It's now an estimated $2 trillion industry. However, some cracks are starting to show. With higher interest rates totally shifting the macroeconomic environment, corporate default rates in this specific space are actually creeping up past their 2020 highs right now.
Which brings us to a really vital mechanism you have to understand: liquidity gating. Because these loans are private, they are highly illiquid. You can't just sell them on a stock exchange in a matter of seconds. When investors get spooked and try to pull all their money out at once, funds actually restrict or gate withdrawals to prevent devastating fire sales of the underlying assets. We've actually seen major funds from Blackstone and Blue Owl restrict redemptions recently, and it's super important to remember that retail, sovereign wealth funds, like the proposed Canada Strong Fund aiming to invest in major infrastructure, carry this exact same illiquidity risk. Your cash can literally get locked up. That brings us to Section 4, geopolitics, tariffs, and trade. Let's pivot over to macroeconomic headlines for a second. Headlines absolutely love to sensationalize trade deals, but let's just look neutrally at the actual economic data. Take the recent Canada-China trade deal, which allows up to 49,000 Chinese EVs into Canada at a reduced 6.1% tariff in exchange for lifting agricultural tariffs. While it's heavily debated, if you look at it purely from an economic diversification standpoint, the numbers are crystal clear. Canada sends over 75% of its exports to the US and only about 4% to China. In the phase of unpredictable US tariff threats, this is fundamentally just a strategy to slightly diversify reliance away from a single trade partner. We see that same kind of noise in regional politics too, like the intense discussions around Alberta separatism. Setting all political leanings completely aside, we just have to impartially break down the economic math being presented. Claims that an independent Alberta could instantly secure massive fiscal surpluses often ignore deep economic realities. Yes, Albertans are net contributors to federal transfers, but that's primarily because of higher average incomes. However, estimates claiming they'd take a $334 billion share of the national pension plan, those are widely contested by economists. Furthermore, secession models frequently exclude the massive, multi-billion-dollar ongoing cost of replacing federal services, things like the military and old age security. The math is just far more complex than the headline suggests. All right, Section 5, your smart investing playbook. We've successfully diagnosed all the noise out there, so now let's actually build your actionable strategy. Here is your trusted financial advisor checklist to insulate your portfolio from the chaos. Rule 1. Always verify AI-generated financial advice with a registered fiduciary, someone who actually has a legal duty to protect your interests. Rule 2. Always check the liquidity lockups before buying into alternative private assets. You need to know exactly how and when you can get your cash out. Rule 3. Ignore short-term sensationalized news cycles and gamified prediction markets. And Rule 4. Stick to fundamentally sound long-term goals rather than chasing the next big overnight multiplier. I really love how this quote beautifully captures the whole mindset. The wealthy deploy cash for growth. They let their money work harder than they do. The noise out there right now is incredibly loud, but properly evaluating real assets, understanding the risks, and maintaining a disciplined, long-term strategy remains the proven, time-tested path to building actual wealth. So I'm going to leave you with this final thought today. Are you letting market noise dictate your financial future? Take control of the signal. Make sure you subscribe for more clear-cut explainers to help you navigate the markets confidently. And please consider consulting a registered fiduciary today to ensure your financial plan is truly built for you. Thanks for joining me, and I'll catch you in the next explainer.